Welcome everybody to the next video of this FX trading course. Now, what we're going to get into in this lesson is we're going to talk about the different trading sessions that there are, the trading sessions that I usually participate in, some misconceptions as well, some assets that you can trade in each session, but also we're going to talk about candlesticks. So it's going to be a shorter lesson than previous lessons, which you probably are gonna love, and then we're going to roll on to future videos as well. Straight after that, there's going to be a few quick videos just after this lesson, and that way we can just keep the ball rolling. And we're starting to get into the technicals now. Alrighty, so starting off with Sydney session. Sydney session starts at 10 p.m. GMT. So I'm using GMT time here because a lot of you guys watching this are going to be living in all parts of Australia and possibly the world. So it's easier to use the general time, which overlaps with the end of New York session. It lasts until 7 a.m. GMT. Commonly traded currencies during the session is AUD, NZD, and JPY. So any pairs with either of those assets involved as either the base of the quote currency will be good to trade during that time. And the reason why we typically tend to trade certain assets during certain sessions is because there's more activity during those sessions. So for example, during Sydney session, assets like the Australian dollar, the New Zealand dollar, and the Japanese yen, major institutions and businesses and global trade is occurring during those times because those are the operating hours for that session, meaning there's just more volume for those assets during that time. Whereas, London session, it's not as active because there's not as many businesses and global trade and, governments operating during that time. Now, Tokyo session starts at 11 p.m. GMT, just after the Sydney session, the typo there, and ends at 8 a.m. GMT. So JPY and the Australian dollar are commonly traded during that time. So a lot of these pairs you can pretty much trade in most sessions. The funny thing is, the Australian dollar you can trade in Sydney session, Tokyo session, but you can also trade it in New York session and pretty much London session as well during that crossover, because the United States dollar is the base, the quote currency, sorry. Now, London session starts at 7 a.m. It's probably one of the most popular trading sessions, and it overlaps with the end of the Tokyo session. It ends at 4 p.m. GMT. London session is considered the most active and liquid session in the foreign exchange market. Any European or US dollar pairs are most commonly traded during this time. So most major currency pairs. New York session, another typo, begins at 12 p.m. GMT and overlaps with the end of London session and ends at 9 p.m. GMT. So all you got to do, guys, is literally convert these times from GMT to whatever your local time frame is. It is the final major session of the foreign exchange market day, and any pairs involving the United States dollar are most commonly traded during this session. So some of the misconceptions are that you can only trade GBP USD or Euro USD during London or New York session, but that is incorrect. There's many professional traders that work for major institutions that actually execute positions during Sydney session or Tokyo session on assets like GBP USD, Euro USD, etc. It really depends on the opportunity. It depends on the timing. It depends on the analysis. So if you have a strategy and your methodology, you've identified a setup and it's perfect. It's a perfect trade. You would take it if it was in London session, but it's in Sydney session. Still take the position. I don't know why people, it's Sydney session, I can't trade it, but there's an awesome setup. I'm just not going to take it because it's Sydney session and it's not London session. No, still take it. The moment I stopped doing that and I actually just started executing trades whenever I found the opportunity to do so and the timing was correct, my trading was so much better. So let's talk about candlesticks. Candlesticks are essentially a visual representation of price movement over a specific period of time. Candlesticks form the foundation for a trader's technical analysis it allows you to understand some of the behaviors and traits of that asset, how it's moving, how it's reacting, etc. So candlesticks are really important, and a lot of traders don't look at candlesticks enough. So candlestick foundations, there are multiple parts of a candlestick that represent different values, such as the body, which is the open and close, and the wicks, which is the highest and lowest. The body represents the range between the open and close price for the candlestick, and the wick is the thin lines on one or both sides of the body represent the highest and lowest price points reached during that specific time frame. And what we're going to do is get into TradingView, and I'm going to show you all of this on the charts, because there's no better way for you to learn than actually on the chart. So let's do it. Alrighty, so we're on the charts now. I just thought I'd get rid of my face so you guys can see the charts a little clearer, but it looks a little bit overwhelming for those that are new to trading. And what we're going to get into right now is I'm going to explain the buying and selling candles. That's, I think, the most important thing straight off the bat before we get into a little bit more complicated stuff, more specific stuff. So these candles here, these blue candles, are bullish candles. They're buying candles. It essentially means that buyers were in favor during this time, that they were the most dominant party over sellers, or compared to sellers. Whereas these bearish candles is when there's been more sellers during that time frame. And we can see that bearish movement to the downside. See, then we have a bullish movement to the upside, then a bearish movement to the downside, the price continues. But now that you understand buying and selling candles, let's talk about these things here. So these are wicks. We were talking about it on that presentational slide. I was talking about the open, the close, the highest point and the lowest point of a candle. So this one right here, and I'll zoom in for you guys. I'll circle it even just so it's easier for you guys to see this candle right there. So what we can see is we had a bearish candle before this candle formed. So what happened was, because this is a bearish candle, the open price was at the top. This wick here is the highest price point that candle had reached during that specific time frame. So I'm on the 5-minute time frame right now, as you can see at the top here. This is a 5-minute candle. So throughout 5 minutes, this was the highest price point right at the top here where this wick is. But this is the open price. So that's the start of the body. This thick part here is the body. This is the close price, which is the end of the body. And this wick is the lowest price point. So it essentially means that price opened here. It might have gone up a little bit and then pushed down. Might have come all the way down to here, then came back up and it closed. Now the opening, because this is a bullish candle, the opening was here. And it's at the bottom of the body now because it's a bullish candle. And the top is the close. So this is the lowest point. This is the wick. Open, close. And this is the highest point. So what would have happened is price came down like this, closed here, opened this candle. As you can see at the bottom, went from 130, 135. Opened here, might have pushed all the way down, came back up, then closed. Next candle, open. See how the open of that candle is at the bottom, close is at the top, etc., etc. Now the close is at the top because the bullish candle. Now the open is at the top because it's a bearish candle. Close is at the bottom, etc., etc. Go through and just sort of get an understanding of how that works, because now we're going to get into what it could actually mean. And what you can see here is, because I'm not going to dive into market structure just yet, but what you can see quite clearly is that price is trending upwards. It's going up, which means it's bullish, which means buyers are more favored during this time period. It's the stronger party. And we can see we've had a high, price has pushed up, we had this rally, then we had a short retracement, and this is the low before price pushed up again. So it's a higher low. But what we can see is two strong wicks to the downside, meaning price is rejecting this area. Price has slowed down during this time period at this price point before pushing up, because more buyers have come into the market here and have pushed price action back up, and sellers have not continued to push the market to the downside. Same with down here, we've had a small retracement, wicks to the downside, this whole rejection area right here. Those are all rejection candles because price has continued to the upside. It's essentially, we've had a move to the downside, rejection, push to the upside, if that makes sense. So what that could mean is, just say you've come onto the charts, you want to take a buy. Price has moved to the upside. You've identified an area that you might want to sell. Maybe it's at this point here where this imbalance is, and we're going to get into that in future videos as well. Price has then retraced, come into your area. It's rejected again. We've had a bullish close. You might want to take a buy there. But because you've seen that rejection and we haven't broken structure to the downside and we're in bullish market structure, that is a pretty good trade. And as you can see, it worked out quite nicely. Now, this isn't my strategy whatsoever. That is absolutely nothing, and you can't profitably trade like that. But it's the same for bearish rejections as well. So we can see that we have a lower low, lower high, lower low, lower high. We haven't created a higher high, meaning we haven't quite pushed to the upside yet. We had a rejection here to the upside, and then obviously we pushed up because we're in overall bullish momentum. But we can see again at the top of this big move, we have this rejection candle to the upside, move to the downside, rejection to the downside, move to the upside. It doesn't always occur like this because we see, there are some indecision candles, I guess you could say. But just go through, have a practice, have a look at how price does that, how it shows those rejection candles, typically at highs and lows, or lower highs, lower lows, higher highs, higher lows, etc., etc. But what we're going to get into is the candle names. So this candle here is called a momentum candle, and it essentially means that price, for majority of that 5 minutes, because we're on the 5-minute time frame again, this is a 5-minute candle, for the majority of that 5 minutes, price was pushing to the downside quite quickly, quite hard. That was very dominant and clearly shown in that candle because we opened and pretty much just pushed straight down. There was no, huge wick to the upside, huge retracement or anything like that. Whereas here in this candle, this is more of a high test. It's actually called an inverted hammer candle because it's bullish. This wouldn't be called a high test candle. Only a bearish version of this would be a high test candle. And essentially high test means we have a high wick. It's been a huge push to the upside and then prices come down and closed, meaning we've had a move like this on the lower time frames, then price has come back down and it looks like price is going to retrace. That's the point at which price could potentially reverse. It's slowing momentum. So if I was taking a buy, I wouldn't really want to take a buy at this candle because this candle indicates that we're showing rejection to the upside. It's rejecting it. It wants to come down a little bit further. Same here. So even though we're in overall bullish momentum, we can see this breakout here. We've broken structure to the upside. I wouldn't want to buy here because it's rejected this whole area. So this is actually a key level right here, and price has come up and it's rejected it, and then price moved to the downside. So that's what sort of how you get a gist of how these candles work. but that is a momentum candle. This candle here is what's classified as a doji candle. A doji candle is essentially a wick to the upside, a wick to the downside, and the body is very small. It's like right in the middle. And it essentially means price is slowing down, it's had a retracement, or it's in indecision. So usually when price is consolidating, you see quite a lot of these. So you can see one right here. That's pretty much a doji candle as well. That's pretty much a doji candle as well. And you can go through and just have a look at these doji candles, and usually you'll find that it's during times of indecision. So we had a push to the upside, volume's quite low at the moment. We had doji candle, then a big momentum candle to the upside. Doji candle, momentum to the upside. So usually when price is consolidating, you'll see these movements because price is doing this. Essentially, it's just moving sideways on the lower time frames. Go through, have a look at those candles throughout price action. Usually you'll find it's during times of consolidation. Now we can look at another example of a huge rally to the upside, and we can see momentum candle. This candle here is mostly a momentum candle, but we can see we have a wick to the upside, and it's indicating that we're starting to slow down now. So if I saw a candle like that, I wouldn't really want to be buying because price is indicating that it's slowing down a little bit. It's coming up, it's retracing. Then we had another one, a little wick to the upside, and it's just essentially saying that it's slowing, price is slowing down. There's not as much volume. This candle here, probably a catalyst had created this candle, but we had an open here, a large move to the downside, swept these lows, and then a huge push to the upside. So that's indicating that buyers have a lot of strength during this time. We can see another doji candle here as well, and a lot of rejection candles. What you need to go away and do is just understand the behavior of how these candles work, where they're located. We can see rejection candles to the upside at this high. What price does, has a small retracement before pushing to the upside. Momentum candle. Now we're consolidating. What does this mostly display? Doji candles. We have small bodies, but doji candles, and lots of it is really wicky as well. Go to different time frames, change your time frames, have a look at different candles, what they mean. Go to the daily candle. We can see, okay, we have a large move to the downside here, a large momentum candle to the downside. Go to the 4 hour. What does that look like? This is what that daily candle looks like on the 4 hour. Go to the 1 hour. What does that look like? Lots of both momentum candles, bullish candles for those retracements. And as you can see, as we step our way down the time frames, we can see more and more market structure. So we have a low, lower high, lower low, lower high, lower low, lower high, as we step our way down. So go through, have a look at these areas, have a look at these candles, rewatch this video as many times as you want. And in future videos, we're going to get a little bit more technical. We're going to get a little bit more strategy focused, and we can talk about how these candlesticks can actually be a confluence in your overall analysis.